All right, let's turn to some truly bad news here, not the mixed bag that the House situation is. Go ahead and put this up on the report. We just had a new jobs report from ADP. And by the way, we're expecting another different jobs report on Friday, so we'll see how that one comes out. Private payrolls rose by only 89,000 in September. That was way below what economists were expecting to see in this report. They were thinking that we'd add more like 160,000 jobs. So, I mean, we're almost half of what the expectation here was. Let me read you a little bit of the details here. They say the report provides some sign that a historically tight labor market could be loosening and giving the Federal Reserve some incentive to stop raising interest rates. Well, that part would be good. They also said, though, that not only has the job market slowed, according again to this report, annual wage growth has also slowed. This is the 12th consecutive monthly decline in terms of wages. So not only are you adding fewer jobs, but the jobs that we do have are seeing very low wage increases, and we continue to struggle, of course, with inflation, which means many workers are taking a pay cut every month, month to month. Now, they go on to say this ADP report can be significantly different from the government's official count. That's the one that comes out on Friday. So we'll see how that one goes. But, this is a very troubling warning sign of where the economy is at a time when, we've been tracking a number of storm clouds on the horizon, including the commercial real estate market, I think is the most flashing red light that has the potential to ripple throughout our entire economy.
Yeah, the mortgage demand is the one that really troubles me. The CNBC, we can put this up there on the screen. They've dropped to the lowest level since 1996, and interest rates heading towards 8%. Obviously, that's a disaster of 8% interest rate. But the low level demand since 96, you may think it's good. We need housing prices to come down. We'll talk about that in a little bit. But I just think, Krystal, that the squeeze on the rental market right now is going to be something that none of us, literally, I think I was 4 years old in 1996. We have not seen that level of squeeze on our current housing supply since then. When mortgage rates are going to be this high and people aren't pulling out, then they're either not moving and they're locked up to where they are, which dramatically reduces inventory. The existing rental inventory, unfortunately, the rental, boom for that is just incredibly contributing to inflation. So I've seen some reports that rent is beginning to stabilize in places like New York City, Chicago, San Francisco, the highest demand rent areas in the country. But critically, that's like 20-something% above what the baseline was in 2019. There are some new rental inventories that are coming online. The other issue with these very, very high interest rates, a lot of people aren't building anything right now. In fact, I saw a report that when you're browsing Zillow, the number of projects which are half completed has never been higher in terms of the share.
Wow.
And it makes sense because people are like, look, I cannot sell this at what would be a profit. I need to just get the hell out of this now. If you're a private seller and you have a brother-in-law or whatever who's a contractor, now is the time to buy. It's a good, you can clean up right now. And especially because in a couple of years, it's not like our housing shortage is going away. I am curious for your take on this from the Wall Street Journal, where Wall Street is betting on American home value. Let's go and put this up there. They think America's home values are overvalued. Quote, as prices paid for the average single family property have still hit record highs, big investors are taking a pass. The single family home right now, in terms of the overall U.S. residential property value index, is at the highest level that it's ever been. It actually dipped slightly in February of 2023, came right back to baseline and even above of June of 2022 from where things were. And I don't really agree with Wall Street, actually, on this one. Maybe I could be totally wrong. I wonder what you think. But to me, it's just, look, structural. We have way too little housing supply, and we have a ton of demand. More and more people are, quote unquote, coming online. Every year, the people get older. They get to the place where they want a house. The pandemic massively changed the actual living preferences for the vast majority of Americans. They want more space. When you want more space, that costs money. And then more space, especially with the inventory that we have right now, which is large, it's big. Like, I think the average American wants like a 2,200 square foot house or something like that. Well, those are expensive. So, and they don't exist very much, and we're building less of it. So, yeah, we could talk housing prices, 6 months and all that. You shouldn't even be betting on that in the first place unless you're literally like a hedge funder. But I don't know. It just seems like prices have nowhere to go but up when the supply is down and the demand is only continuing to be high. and high in the future. Even if you're a residential landlord or something, you could still get probably pretty good rent from where you could have not that long ago.
Yeah, I mean, I really don't know, but there is a logic to the prices, which is just what you said.
Yeah.
There's no supply. We have dramatically underbuilt, especially at the sort of like starter home level of house. Now with mortgage rates inching up to almost 8% on average now, people who are in a home, they don't want to sell. So then you don't have that churn adding to the supply on the market. So yeah, if you don't have sufficient supply, just thinking of like the basic laws of supply and demand, the prices make some sense to me. If the report is accurate, it's kind of a double-edged sword, because on the one hand, you're like, oh, okay, good. Private equity is like not like buying up whole neighborhoods like they were. They're taking a step back. That's probably a good thing. They're not, buying up the American dream as they were aggressively doing before. On the other hand, if you're like, paying too much for a house to get ripped off, that's a bad side of things. So I don't know. I'm not sure whether it's accurate or not, but it's interesting to see the way that Wall Street is looking at all of this. In terms of the overall economic numbers, I think there's just a lot to be very nervous about, because not only do you have a housing market that is wildly unaffordable and basically it's sort of frozen, right? Mortgage demand way down. People can't buy homes. People can't sell homes. Everybody's just sort of stuck in place, right? So housing market that is totally stuck. You've got commercial real estate market, which is like actively in a free fall and with a huge debt reckoning coming imminently over the next 1 to 2 years. You have student loan debt payments, which are just restarted this month, and a lot of question marks about what that's going to do to consumer spending. And you continue to have, a lot of worries overseas. We've been covering what's going on in China. We're not insulated from, if there are huge shocks to a giant economy like that and there's massive fallout, like that's going to hit us as well. So there's a lot to be very wary of. And when you add on top of that this latest really bad jobs report, because the one thing that you could say about this economy was, okay, well, wages might be low and inflation might be high and there might be these other problems, but at least there's a lot of jobs, right? And that tight labor market has also really contributed to the labor energy that we've seen in all these strikes and all these new workers forming unions, which is incredibly positive, incredibly hopeful. The tight labor market has been a key part of that story. So if that part is going away and easing up, it's a very troubling picture overall that we should be keeping our eyes on.
Yeah, because that was always the Biden defense. They're like, yeah, but look at the unemployment rate. And like, it didn't matter how much we talked about inflation, underemployment, wage growth, all the structural factors which make it so it's like, yeah, it's great to be employed, I guess, but it's better than being unemployed. But what's worse is high unemployment, which is frankly what they want. They want the Federal Reserve, and very high inflation, which is caused structurally by a whole bunch of supply issues. The price of gas, shelter remain the two driving forces behind all of inflation. Those basically have nothing to do with the government spending. They have a lot more to do with real policy implications. And so when you look at that, it's a very, very tough situation for the average American right now. The only thing worse is unemployment, which appears to now be going up. So we talked a lot about this. The Biden people were betting on a quote unquote economic recovery coming in 2024. Looking at this, I actually would probably take the other side of that bet.
Yeah, it's not looking good. It's definitely not looking good. Hey guys, if you like that video, go to breakingpoints.com, become a premium subscriber, and help us build the best independent media organization on the planet.
That's right. We're subscriber funded. We're building something new. We want to replace these failing mainstream media organizations.
So again, to subscribe, it's breakingpoints.com.